A mortgage. For most people, it's the single biggest loan they'll ever take out. It feels pretty straightforward, right? You borrow money, you buy a house, you pay it back. Simple. But what if I told you that's just the very beginning of the story? That your mortgage actually goes on this incredible, complex journey, transforming from a simple loan into a financial product that's traded on Wall Street. Today, we're going to follow that journey from your front door all the way to the trading floors and see how this one loan actually helps shape our entire economy.
Because you know that stack of papers you signed doesn't just sit in a filing cabinet at your local bank. Oh no, it gets bought, it gets sold, it gets chopped up and repackaged in a massive system that connects your home to the global financial markets. And understanding that journey, well, that's the key to understanding how modern finance really works, and even what caused the huge financial crisis back in 2008.
So let's start at square one. Before any of that crazy stuff can happen, your mortgage has to be born. And it all begins with you, the home buyer, and a lender.
At its absolute core, a mortgage is what's called a secured loan. The bank hands you a huge pile of cash, and in return, you pledge your house as collateral. And this is the critical part. If you stop paying, the lender can foreclose and take the property. That security, that house backing the loan, is what makes this entire system possible. Okay, so right out of the gate, you have to make a huge decision. And this choice basically determines who's going to carry the biggest risk for the next 15 or 30 years. Is it going to be you, or is it going to be the lender?
On one side, you've got the classic fixed-rate mortgage, the FRM. Your interest rate is locked in for the life of the loan. It is predictable, it's stable, end of story. If market interest rates suddenly shoot for the moon, hey, that's the lender's problem, not yours. They're stuck with your lower rate. But on the other side, you've got the adjustable rate mortgage, or ARM. With an ARM, your rate can change. You might get a really low teaser rate for the first few years, but if market rates go up, your monthly payment goes right up with them. With an ARM, you, the borrower, are the one taking on all that risk. And this difference, it is going to be incredibly important in a little bit.
So, how does a lender even decide if they want to give you a loan, and what kind of interest rate you'll get? Well, they need a fast, simple way to size you up. And that quick assessment, it really boils down to just one little 3-digit number, your FICO score. It's basically a standardized grade of how reliable you are with money, and it's the first hurdle you've got to clear.
Now, what's really interesting here is what goes into that score. Just look at the two biggest pieces of the pie, payment history and amounts owed. Together, that's 65% of your score. It really just comes down to two simple things. Do you pay your bills on time, and how much debt are you already juggling? That's what lenders care about most.
And this score is used to sort all borrowers into two main categories. If your score is above 650, you're usually considered prime. You're a good, solid risk. But if it's below 650, you land in the subprime bucket. Lenders see you as a much bigger risk. Now remember that word, subprime. It's going to become very important.
Okay, so you got approved, you signed the mountain of paperwork, you've got the keys to your new home. For you, the hard part's over. But for your mortgage, oh, its journey is just getting started. Your loan is about to be sold.
You see, for a long time, this was a massive headache. How could an investor in, say, New York possibly know if some random family in California was going to pay back their loan? Every single mortgage was unique, and it was just too complicated and risky to trade them one by one. But then came the big idea that changed everything, pooling. The breakthrough was, instead of trying to sell one individual, quirky mortgage, what if you bundled thousands of them all together? Suddenly, the risk of any one person defaulting just gets lost in the crowd. It's diluted in this giant pool. This was the game changer. This whole process of bundling has a name: securitization. You can think of it like a financial assembly line that takes thousands of individual home loans and transforms them into a brand new product that investors anywhere in the world can easily buy and sell.
So let's walk through how this works. Step 1, it starts with you getting a loan. Step 2, your local lender, who doesn't really want to hold a 30-year loan on their books, sells it to a much bigger financial institution. That institution then buys up thousands and thousands of similar mortgages and bundles them all into one giant pool. I mean, think of it like making a smoothie. You're taking a bunch of different individual fruits, those are the mortgages, and blending them all together into one uniform drink. That final product is called a mortgage-backed security, or MBS. And when investors buy this MBS, the money they pay flows all the way back down the chain to your local lender, giving them fresh cash to make even more loans. It's a cycle.
Now, this enormous market didn't just pop into existence. It was actually built by these government-sponsored giants, Ginnie Mae, Fannie Mae, and Freddie Mac. They're the ones who created the rules, bought up all the loans, and, crucially, guaranteed the payments. That guarantee gave investors the confidence they needed to pour trillions of dollars into the U.S. housing market.
So let's put on our investor hat for a minute. Buying one of these mortgage-backed securities seems pretty great, right? You get a nice, steady stream of cash as all those homeowners make their monthly payments. But it comes with a really unique kind of risk, one that you just don't see with normal bonds.
It's called prepayment risk. See, unlike a regular bond, a mortgage can be paid off early at any time by the homeowner. And when do people do that? Well, they do it when interest rates fall so they can refinance into a new loan with a better deal. For the investor holding that MBS, this is a total disaster. They get all their money back at the exact moment they don't want it because now they have to go and reinvest it at those new, much lower rates.
Okay, so we've got all the pieces on the board now. Prime and subprime borrowers, fixed rate versus adjustable rate mortgages, and this massive global market for mortgage-backed securities. For a while, this whole machine worked beautifully. But in the mid-2000s, it started to spin completely out of control, and that led directly to the meltdown of 2008.
I mean, just look at this number. The market for subprime mortgages, remember, those are the loans to the riskiest borrowers, it more than quadrupled in just 5 years, hitting $1.8 trillion. The demand for more and more mortgages to feed into that MBS smoothie machine was so intense that lending standards were basically just thrown out the window.
And this lays out the chain reaction perfectly. First, you had the boom, and it was fueled by all those risky subprime loans, and a whole lot of them were those adjustable rate mortgages, the ARMs, with those low teaser rates. Then came the trigger. The U.S. Federal Reserve started raising interest rates. For all those homeowners with ARMs, this was a ticking time bomb. Their payments suddenly reset to levels they just couldn't afford, which led to a massive wave of defaults. And all those subprime mortgages that were supposedly made safe inside an MBS, they started to go bad all at once.
You can literally see it happening right here. That gray line, the Fed funds rate, it starts climbing, and climbing fast around 2004. That's the rate that directly impacts those ARMs. As it went up, it just pushed millions of homeowners right over the financial cliff. This wasn't just some line on a chart. This was the direct cause of the foreclosure crisis that followed. So here's the bottom line. These MBS investments, which everyone from pension funds to major banks thought were super safe, were suddenly revealed to be stuffed with toxic, defaulting loans. Their value just collapsed. And because banks and investors all over the world owned these things, the crisis that started on quiet suburban streets in America went global, almost overnight.
Now, the system was rebuilt after 2008 with a ton of new rules and regulations. But the basic structure, that financial assembly line, it's still there. Mortgages from Main Street are still being bundled up and sold on Wall Street. And that leaves us with a really critical question to think about. We know what broke the system last time, but in the incredibly complex journey a mortgage takes today, where are the new hidden risks we might be missing?